You ready?
Yeah, go.
All right, you're live in 3, 2.
Good morning, everybody. I hope you're doing well. Sorry, a little bit of technical difficulties this morning. We're going to start off this morning with three stocks that I want people to buy in or at least trade around this morning. The first is Asana. Dustin Moskowitz stepping in, buying a lot more of the stock. I'm looking at the $24.50 call for next Friday or the $24 call. Having issues with TD Ameritrade this morning, which isn't surprising. There's going to be a lot of activity today, a little bit more volume than usual. Consumer sentiment's coming out in about 30 minutes. Why does that matter? Because it's going to have a dramatic impact on the market. We're going to probably see a little bit of a run this morning. I'm just trying to get into TDA. I do not understand why this is not working. It is what it is. All right, you're going to look at Asana right now. The other names I want you to pay very close attention to are BFly, BFLY. This is a consumer bank that or forgive me, Butterfly Network. This is a stock trading at about $250 right now. It's up 6% this morning. Very small cap, $2.50. Buy to open the stock. We're going to just set a very tight stop on it. This is a short-term swing play, looking for about a 5 to 10% gain on this stock in the next week. So we're going to buy Butterfly Network, BFLY, at market price, set a 15% trailing stop off the bat. All right. Asana, still trying to get in there and try to get a hold of the actual options chain. Today, if you're joining us for the first time or you've known me for a while, we're going to be talking about a couple of things that are very important. Really key thing here today for you to learn how to trade and to focus on breakout momentum stocks. Key thing is going to be the big rotation out of the Nasdaq over the next 10 days. They're going to effectively rebalance the Nasdaq, going from 100. The top 7 stocks cannot be more than 50% of the weight of the index. They're going to be cutting that over the next 10 days. You're going to have this activity that's going to start on after the bell today. They're going to make the announcements. They're going to implement them on July 24th. So that will be a Monday when it starts. And I'm going to be teaching you today how to actively trade this, because there's going to be a lot of activity on the QQQ, on Apple, Microsoft, all of the big names. But there are leveraged ETFs that you need to learn a little bit about and how to trade them. We're going to go through that this morning. Right now, looking at Asana for 2 weeks from now. Currently, the July 21st, next week, the $24 call is trading for about 95 cents. We're going to go through a way to structure a trade right now to look for Asana to continue to break out on the back of its this news of Moskowitz stepping in and buying a significant amount of the stock. Instead of us going out of the money and buying a very expensive or low probability call, let's just take a real quick look at Asana. If you were to buy a call and you are trading for next Friday, I want to teach you a little bit about probability of profit. So right now, Asana is trading at $24, and hopefully I'm sharing my screen correctly, right? Okay, good. $24.43. So that is the price. If I go out to next Friday and I buy the $24.50 call for next Friday, it is currently trading at about 80 cents. Now, that means in order for us to make money on this, you're going to need this stock to climb at least up to the $25.30 level. Now, you can make some money in the short term if the stock pops today, but if you were going to actually try to make money on the duration of this trade, you need it to be above 25.30 on or before that date, and it's a 37.8 probability of profit. If we do a call spread, however, which reduces your risk and gives you a little bit more downside protection and assigns you right off the bat the actual percentages that you could potentially make as a trader. 24.50 is the current trade. If we look out to next Friday, let's say that you bought trading for about $1.65. If you buy that call and then you go out and you write not too far above the $24 level, $24.50. You could look at the $25 call. And what this is going to cost you, $25 call currently trading at around 60 cents. Let's call it 60 cents right now. That's going to cost you $1.05 for this position. So $105. But look at the math right here. You now are putting up $105 to make potentially $95. Your max return on risk is $90 return through next Friday. Your break even for this trade is actually below where the stock price is right now. So currently the stock's trading at about $24.45. your break even is $24.05. And as you can see, the probability of profit for this type of spread is actually a 55% probability of success. And that is the difference between wildly speculating and actually managing your risk in a responsible manner. So we're going to add that position to our portfolio today. We're going to buy to open the Asana, A-S-A-N-A, ASAN, $23 call for the best price for July 21st, 2023. And we're going to sell to open the $25 call for ASAN for July 21, 2023. And all we're doing is setting a spread, and keep in mind you now have 40 cents of protection to the downside. You have about a 1% to 2% protection on the downside. And what's really nice about this type of trade, you could set a stop. Your stop could be if the stock falls to $24.10. That's the easiest way to measure it. Now, on top of this, as we look across the market right now, we are building this trade on the back of what is known as insider buying. So I'm going to be talking today, I'm going to be on a panel with John Malden and a handful of other investment experts. And I was listening to Alex Green talk from the Oxford Club yesterday, and he was over the moon over the fact that insider buying at two major companies have been very robust over the last year. And the general consensus here, insider buying is an anomaly. But the key thing to keep in mind when it comes to insiders buying their own stock, go back to the Peter Lynch quote that is on this page. Insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise. Okay, so there has not been a ton of insider buying over the last couple of weeks. Obviously, earnings are in play right now. But if you look at the biggest insider purchases of the last couple of weeks, the reigning champion by a wide margin is Asana. The two big insider purchases of the last year have been Energy Transfer, which is a great pipeline company, company that we technically own through the TTP and a handful of other pipeline ETFs. But Asana is the biggest amount of insider buying over the last year. And this is Dustin Moskowitz. He is a former founder of Facebook. He has been buying up his stock at $21.72. Asana getting another pop on the back of that purchase. There's been $1.6 billion in insider purchasing over the last 12 months. But most importantly, going back to effectively mid-June, you're seeing him step in and buy 5.5 million of his shares, 3.6 million of his shares, 3.6 million, 3.4, 3.4. And with momentum very positive on the back of the CPI data and the PPI data, we're looking for a higher probability of profit trade with a little bit of protection to the downside. And it's the credit spreads that allow you, or the call spreads that allow you to try to take advantage of that. The other names that I'm paying close attention to today, obviously I'm watching the Qs. We're going to talk about that in a moment. I'm looking at a company called JFin. I don't know much about it. All I know is that it's popped up on the screen. So this is Jalen Group. I believe that it is a Chinese communication stock. This had a positive breakout on the RSI, positive breakout on MFI, crossover positive move on MACD, and the ADX is all positive right now. This is one of those stocks that is not very widely traded. It has a relatively small volume compared to some of the other things that we are typically focusing on. Very low short views right here. Book per share is about $4, currently trading at 6.8. You've got a big gap to the upside that could be exploited. So the way to trade a stock like this, particularly on a Friday like today, a day like today, which will likely see lower volumes as we move later into the day, is that you buy the stock, you set a very tight stop, 2%, 3%, and you're hoping that momentum just continues to have this thing squeeze higher through the duration of the day. In addition, looking into next week, just a couple of basic names that have popped up in terms of broader market. JPMorgan today, great earnings report. JPMorgan is effectively, in a lot of ways, much like any of the other major tech companies. This is the biggest dog in all of finance. They have the largest amount of assets compared to anyone else in the financial markets in the United States in terms of the banking sector. Obviously, BlackRock has more assets, but JPMorgan is the largest commercial bank. an institutional bank buy assets. This company had a very good earnings report today. It has just moved into technically overbought territory on the week. The thing about this, though, is that when you get into this type of name on a day like today, and we look at TradingView, for example, to get a good perception, TradingView, we look at TradingView. If you pull up JPM, you're going to see a significant amount of momentum in this stock to start the day. And that's going to take us into our conversation that we're going to have about the individual stocks on the S&P 500 or the S&P and the Nasdaq 100. I'm going to explain in a moment what is happening with the Nasdaq and how we're actually going to trade it and why there's so much opportunity. So we've seen this move down on on JPMorgan to start the day. A little bit of selling the news on the back of the earnings report. This came down, effectively hit the second standard deviation band, and has been moving higher. If you're going to speculate on JPMorgan for the rest of the day, the way to do that is through the utilization of these Bollinger Bands. And I want you to get comfortable with this, and I want you to understand this very briefly, because this is going to set up the trading and the investing and the reallocation focus that we're going to have on the Nasdaq over the next 10 days. Okay, so the blue line that you were looking at, this is TradingView.com. This is the 1 minute volume weighted average price, which is known as VWAP. Each one of the lines that comes out of the other side here, this is the deviation bands for price. So standard deviation, movement, you have the first standard deviation, which are these lines, you have the second standard deviation, which are these second lines, and then you have the third standard deviation. Now, why does this matter? Well, as we have seen, going back to a 2018 statement by Stanley Druckenmiller, the famed hedge fund manager, he had noted that there really is not a trend in this market. And the problem that he was pointing out was that the sheer amount of algos that are involved in buying stock in this market, they step in whenever these readings move into the third standard deviation. So there are algorithms that are programmed to buy the dip. Keep in mind, about 80% of trading is done with algorithms. It's done with machines. They have no emotion. They have no bias. They simply are looking for these massive types of sell-offs that are typically fear-driven, and then they step in and bid. And as we move later through the day, if we're down here at around 12 o'clock today, look for the market to revert. Now, I've focused my entire career on a handful of anomalies. We've talked about insider buying and selling. We've talked about value and how we identify it. But momentum is really my bread and butter. We have a kill switch on the markets. Our focus is heavily on how do we manage our risk when it comes to managing a portfolio and to trading. When this indicator has gone red, we have seen dramatic sell-offs transpire over the last, not 1 year, but effectively 7 years. So this is the S&P 500 ETF. If we go back 1 year, you're going to see a couple of these little negative signals. We are getting these signals on that specific day, and we are witnessing sell-offs. This is the December sell-off that was due largely to tax harvesting. This was the sell-off fueled by Jerome Powell. But we go back to this one. This is the most important sell-off of last year. We had a negative signal on June 8th of last year. And we sold. We got out of the market. We went short. And the market sold off, and we had the largest sell-off of hedge funds in 15 years transpire that week. Now, we did not know that this is why this sell-off was transpiring. We just simply knew capital was flowing out of the market very, very quickly. So we got out of the way, and then we found out about the hedge funds about a week later once we got data. And if we go back to March, we had a negative signal start in February and a bigger negative signal on March 7th. We thought, hey, maybe it has something to do with the energy markets. Maybe it had to do with this kind of overbought people taking profits. No, ultimately what we discovered was this sell-off had started largely on the back of that banking crisis that happened in March. If we go back 5 years, we had a negative signal happen on February 24th, 2020. It was COVID. And sure enough, the market fell by 30%. And the same thing happened back here in 2018. We started getting out in September of 2018 That was before the market freak out, the bond freak out, and then ultimately the 20% decline in the S&P 500. Now, one of the big challenges, unfortunately, is that momentum has usually been on a weekly to monthly basis. But given the explosion of zero-date options, given the explosion of this kind of buy-the-dip mentality, we have seen an environment where momentum cycles are getting tighter and tighter and tighter. And as a result of this, you're actually seeing on a day-to-day basis sell-offs that will start the day. They'll come down and hit this band or hit one of the first standard deviation bands, and the algos step in and start buying, and these things start to move higher on the day. Another good example of this transpiring was on Wednesday. On Wednesday, you had a little bit of a move higher to start the day. People sold off, effectively taking gains on the back of the CPI data. It kept bouncing off this second standard deviation band, and then ultimately at 12, the buy the dip lunch crowd came in, and the S&P 500 jumps from 444 to 446. Now, that does not sound like a very big move, right? It's only a 2-point move on the S&P 500. But if you are trading options that expire that day, and you buy an option that expires that day, and you buy something that maybe the 445 or the 446 call for that day when it's trading somewhere around 40 cents to 50 cents, all of a sudden this thing screams higher over the next hour, hour and a half, and something that you bought for 50 cents is now worth $1.10, $1.20. This is occurring more and more. It's not something that I necessarily love to do. I don't like to sit in front of a computer the entire day and try to actively trade this, because you have to actually be there the entire day to do it. But as we've noticed this trend, we've noticed this phenomenon continue to accelerate through these markets. I think this is going to be the future of the market. So it's very important that if you are a trader, I teach you how to do this. We continue to do so every week. We focus on this on Fridays. I walk people through it at lunch. That's part of what we do at Flashpoint Elite. And if you're not willing to trade options, there are other tools that you can use. So, for example, the SPXL, that is a triple leveraged ETF around the SPX, S&P 500. And right here, it was at 90.67 a few days ago at 12 o'clock. And this rallied up to about 91.78. Now, as you are actively trading this, and we're going to be talking about this with the Qs in a moment, the key thing to keep in mind is that you can buy when it comes down at this level, and you have a natural exit point. If the market does not revert, the worst you're going to lose is going to be somewhere in about a $10 to $15 type of risk situation. So if you bought 10 shares of this and it cost you $906.20, your stop might be $90.50, which is down here. But if it takes off and it reverts, all of a sudden you've now turned a trade from $906 into $918. It's not a massive move, obviously, but if you increase and you go to $9,000, you now have $9,000 in leverage. Then you're ultimately looking at the possibility of making some money. Now, if these things turn right back around and you have a 2% rally, we have seen days where the SPXL has gone from around a $90 level and then percentage-wise ripped up 2%. And now all of a sudden you're looking at something that's trading at $92, $93, $94. That's how you do it, and you manage your risk at the same time. All right, so the key thing moving forward, as we move into the backside of 2023, we are watching the QQQ, and the Qs are rising today. The Qs are the Nasdaq 100. The Nasdaq 100 Trust is an ETF that is structured with the weight of the S&P 5 or of the Nasdaq 100. The weight of the Nasdaq 100 of the Nasdaq 100 is overwhelmingly 7 stocks. Right now, the number one stock on that index is Microsoft. And let me actually pull this up for you so that you can see this. This is the composition. Microsoft and Apple both have weight 12.6% for Microsoft. Apple is over 12. As a result, these stocks heavily influence the QQQ. You have NVIDIA at roughly 7.3%, Amazon at 6.8%, Meta, Tesla, and then Alphabet. Now, those 7 stocks, that weight has effectively moved above 50%. The rules state that is not allowed. So very simply, when it comes to this, if you look at this Nasdaq, they have a rule in place that effectively states they are not allowed to be over roughly the top five names: Microsoft, Apple, NVIDIA, Amazon, and Tesla. They are not allowed to be over 40% of that rally. Now, what has happened? Take a quick step back. This rebalance is to reduce the concentration of those heavyweight companies that are effectively half of the entire index. So you go up and you look, and there's 7 total. Obviously, you add Google, and you add the other name. I'm blanking on it. Forgive me. I need to have some coffee. Okay. So right now, Microsoft, NVIDIA, Amazon, and Tesla are 43.8% of the index. The rebalancing that they're going to do to bring this back in line will take those names down to 38.5%. Now, the argument is that this heavy concentration of capital is not healthy for the market. And what we have witnessed this year is if you eliminate those top 7 names, the S&P 500 and the markets are effectively flat for the year. Yes, there have been a lot of those kind of junk stocks that have rallied through the beginning of the year, the YOLO growth stocks with bad price to sales valuations. But it has been the crowding into these mega cap stocks, particularly due to fear of the current market. This has become a crowded trade. And I know that a lot of people like to sit here and tell you that it has a lot to do with artificial intelligence that is driving it. It's not just artificial intelligence. The reality is, if you look at AI in 2023, and you go back and you look at the AI Expo, which transpired back about 2 months ago, John Deere, PepsiCo, and a handful of other big S&P 500 names all presented and talked about the future of AI in their businesses. Well, unfortunately, what occurred as a result, they did not rally on the back of optimism around AI. There are other things that are impacting these sectors that people aren't talking about. The first thing, I've talked about Amazon. Amazon, because of higher interest rates, has billions and billions of dollars, tens of billions of dollars, roughly $80 billion at the end of the year in their accounts payable on their balance sheet. They do not pay their vendors for 45 days. They take that money and they can buy short duration bonds that are paying 5.6%. So then they get that money after 30 days and then they return it to their vendors. Their vendors are giving them a risk-free, interest-free loan for 45 days because of the way that Amazon manages its cash flow and pays its vendor. The second thing that's important to keep in mind is that venture capital has collapsed here in the United States. The amount of money that is flowing into new venture capital deals is down, and it's down significantly. It was very bad in December. Q2 looks like it's going to be very bad once we get the final numbers. And that is distressing because a lot of the competition that comes down the line for an Amazon and a Google and an Apple, it all starts in the venture capital world. So future competition has been knocked out. Now, as we look at this, companies like Apple and Amazon and Google, they all have their own venture capital arms. So they're already invested heavily into a lot of these AI, other future types of technology. And remember, once again, the way that they manage their accounts payable and their cash flow, they are making more and more money that they can plow into future projects. So as we look at the next week, what's going to happen? Today, after the market closes, the Nasdaq is going to announce its rebalancing. The rebalancing is part of the Nasdaq's methodology that is with compliance within the SEC's rule that has been done 2 times before. This happened back in 2011, which in a very similar situation, there were concerns about the state of the market. Funds crowded into these names, and it became a safety play. So even though the underlying market, the S&P 500, is getting beaten up, those bottom 493 stocks, funds all crowded into these big tech names. They did the same thing back in 1998 as well, at the onset of the dot-com bubble. One of the key things to keep in mind is that hedge fund managers and ETFs will buy stocks because they are not trying to beat the market. They're not trying to beat the S&P 500, or they weren't initially. They were trying to establish what is known as edge. And when they are unable to perform because they're not good managers, I'll give you an example in a moment, what they do is they start to crowd into stocks that are part of their benchmark. So here is an example of this. Apple, as a stock, there were 403 ETFs, exchange-traded funds. These are passive investment vehicles that are launched by individuals who are simply trying to make money by managing a portfolio of stock, and they get a 1%, 1.2% expense ratio from investors. So investors who don't want to manage their funds, they want to invest in a theme, for example. Maybe a theme is they want to invest in cybersecurity. Maybe they want to have be part of AI. These groups go out, State Street, Vanguard, BlackRock, a number of other groups. They buy up a bunch of stocks, they create a thematic fund, and then they sell the ETF on the market. You buy that ETF because you're excited about a very specific theme, or maybe you just want to replicate the S&P 500 or the Nasdaq. They will charge you 1.2% to do so. Now, on the back of that, what happens is you start to see fund managers throw in the towel on their themes if they are underperforming. And a perfect example of this was an ETF that was called the Knights of Columbus Catholic ETF. Today, the Catholic ETFs, here it is today, it has renamed itself the Global X S&P 500 Catholic Values ETF. What did they do? Well, they tried to create an ETF that was built around Catholic values. Now, I grew up Catholic, so I would understand what some of these things are. Because they were getting their teeth kicked in by the market, they simply started to buy and weight their assets in the same way that the S&P 500 is weighted. Apple, Microsoft, NVIDIA, Tesla, Alphabet, Meta, Alphabet, Berkshire, these are the top 8 stocks in the entire S&P 500. And this isn't just happening at this ETF. This is happening at hundreds of ETFs that are abandoning their individual themes, and they're turning around and just simply trying to match their benchmark. The purpose of an ETF is not to outperform the market. It is to get as close to your benchmark as you possibly can. And the way that they do that is simply to build their portfolio in a way that replicates the S&P 500. You have had trillions of dollars poured into passive investments. And as a result of that, as people are building up these ETFs, or fund managers are just trying to match their benchmark, which is the S&P 500, they have been crowding into these names. And as a result, that has become, quote unquote, the safety trade of this year. It happened before. It happened back in 2021 as well, where the S&P 500 rose, but the undercurrent of the market and the Russell 2000 effectively remained flat. And that crowding has actually thrown off momentum readings for the last 6.5 months. Why we are seeing this short duration momentum, even though a lot of other names have been continually bleeding off to start the year. Now we're starting to see capital come back into the market, but the crowding is up here. So what are they going to do? Well, they will rebalance this, and it must be conducted to, if the aggregate of those weights is more than 4.5% of the index, and it goes up to 48%, right? So they're going over 48%, and when there is a rebalancing, they cap this rebalancing at 40%. So Microsoft had the largest weight 2 days ago. It was about almost 13%. Apple's at about 12.5%. NVIDIA at 7.7%. Amazon 6.9%. And Tesla at 4.5%. When there was a rally in Tesla recently, including that rally on the back of Rivian stock, because Rivian has been off to the races, that pulled the aggregate weight above 48%. That automatically triggers the rebalancing. Now, the question for a lot of people is, what is going to happen with the S&P 500? There is a distinct possibility that the S&P 500 could also see a rebalancing as well. And that happens when the top companies are exceeding 50% of the total index. Apple and Microsoft are the only two companies that have weight over 4.5%. That's important. You can't have, I believe, 5 companies over 4.8, and that exceeds 50%. The top 5 companies with the most influence in the S&P are Amazon, NVIDIA, Tesla. They're 22% of the index total value. So there is very unlikely that that's going to happen. But now let's start to talk about what is going to happen when we see the rebalance. Okay. The companies that are most likely going to see an increase in their weight on the Nasdaq 100, which can lead to a pop in those shares. And you can position yourself accordingly ahead of time. And we're going to talk a little bit about how to do this. But let's just talk about the names themselves. The first is Starbucks. Starbucks, obviously, you know what Starbucks is. If you don't, then you live somewhere hundreds of miles outside of a city. Little green cups, Starbucks is everywhere. This is a coffee maker based out of Seattle. And Starbucks has been absolutely neglected. A lot of people have been not paying a lot of attention to it. The expectation has been that consumers are going to run out of money and stop shopping here. Well, sure enough, it has continually found support down at around the $97 level multiple times, going back to June, going back to March, and going back to December. We could see an increase in shares of Starbucks in purchased. Mondelez. And we're going to talk about how to trade them in a moment. Mondelez is a company that spun out of PepsiCo a long time ago, and Mondelez is a snack maker. This was a company that was very, very favorable into this year, had a big pop-up to about the $80 level. It has sold off since May, and you're coming off of this wedge that has, or this short-term line that's been coming down or going up, going back to October. Just real quick, if you've never listened to me talk today, if you're asking, where's the stock market going to go? Where's the stock market going to go? Are we ever going to see the market get back to 3,800? There were 4 pivots back in October that a lot of people missed. I pointed that out on a panel today, and somebody walked up to me and said, oh, God, I think you're right. The Central Bank of Japan increased and eased last December. People's Bank of Japan eased in November. The United States Fed pivoted on mortgage-backed securities in October, and then the Bank of England pivoted and effectively capitulated on inflation back in October. So my short-term expectation heading into 2024 is that we're not going to get back to 3,800 anytime soon. It'll probably be in 2024 if we do see that real recessionary sell-off. The United States government continues to spend money at a blistering pace. We'll talk a little bit more about that soon. But nonetheless, my expectation is I don't see us getting back to 3,800 this year, but I do certainly foresee a recessionary concern in the first quarter and Q2 of next year, and that's going to put a lot of pressure on the market in the near term, in those next 9 months. Now, Mondelez is in this channel right now, coming up, and we are now down at this 71.70 level. This stock could obviously continue to break down. I'm going to talk about different ways to just trade it for security and for safety. But Mondelez is one that that appears would probably see an uptick in its weight right now. Consumer defensive stock. Other names: Booking Holdings. Booking Holdings, BKNG, is a very expensive name. Travel is holding up very well right now. American Airlines absolutely has been on fire. Pure momentum stock right now. The people continue to travel. Now, this is a very expensive stock. I don't like to trade any stocks that are over $1,000. But if you're looking at something that could see an increase in its weight, Booking stands out as well. I have Gilead as a potential company as well. GILD, if you know the healthcare sector. This has been kind of selling off and kind of this pattern moving lower. It keeps finding some level of support, but GILD is on the list. And the final one is automatic data processing, ADP. So coming out of conversations with Wells Fargo and looking at this, ADP kind of bottomed out in May. You continue to see a resilient job market. Even though, a little bit of a slowdown, the ADP had a big drop coming out of December from 270. It kind of bottomed out at the 200 level, and it's been getting a little bit of increased improving momentum over the last couple of weeks. So now, how do we trade this stuff? Well, as I noted, Starbucks, SBUX, if you look at Starbucks has consistently found support down around that $95 level. Now, some people might look at Starbucks right now and say, well, I think that it's going to go to 110 based on the rebalancing. I'm going to be very honest with you. One, I can't confirm that Starbucks is going to be the number one company that's going to get the most buying. It does, from the analyst reports that I have read, it is the most consistent name that continues to show up. But when it comes to this speculating to the upside, remember, when it comes to trading and when it comes to investing, you want to be focusing on probability. You want to have a better assessment of how the market actually operates. And remember, the purpose of a market is to sell. So remember, when people are selling calls, they likely own the underlying stock. That means if you buy a call on Starbucks at 110 and they currently have the shares at 101, if you're speculating to that upside, the person who is selling that call to you likely owns the stock. And if they own that stock and the shares go to 110 and they have to hand you the stock, maybe you dump the contract, but they're going to make money. They're going to make money selling you the call, and they would make money from the appreciation in that call of the underlying shares. Roughly a 10% gain for them, plus the contract that they are selling to you. So I want to remind you that, because it's very, very, very speculative for somebody to step in and try to buy a call and simply believe, oh, this is going to absolutely go to the moon, do the rebalancing. I don't want you to think this way. I want you to think a little bit more proactively and understand that you too, as an investor and as a trader, can take advantage of something by increasing your probability of success and focusing on the primary trade that we do at Flashpoint Elite on a very regular basis. Starbucks, as an organization, company tip, if we go to tip ranks, Starbucks is one of those very consumer resilient names. We continue to see people going out, spending money and buying. They're not dumping their Starbucks. People might be $30,000, $40,000 in student loan debt, but they're still paying $5 a day for their latte. And if we look across the board of the market, you have a lot of very good consumer analysts who are stating this stock's worth $104. It's worth $127. It's $131 from Bank of America, $125 from BTIG. And these are all very good analysts with their rating and their track record. With that, if this stock is currently at $101, then wouldn't logic suggest to you that it would be great if you could buy that stock at a lower price? And there is a way to make money simply by putting up a little bit of capital, picking a price that you are comfortable with, and trading around that number. And the way that we do this is with puts. Now, a lot of people might look at Bank of America right now, for example, or forgive me, Starbucks. Sorry, I'm reading as I'm talking. I'm going to look at the options chain really quickly. So the options chain for Starbucks, currently going out to August 18th, has the $95 put at $1.17. Okay, so let's take a real quick look at this, and let's look at a cash secured put. And then I'm going to show you this, and then I'm going to talk you out of doing a cash secured put, because I want to show you how much money you need to put up in order to do this put. On August 18th, the $95 put is $1.15. That means you need to put up $9,385 in margin to potentially make $115. Now, when you sell someone a put, you are selling them the right, but not the obligation, to sell you 100 shares of that stock if the shares fall under at $295 or below on or before the strike date, which is August 18th. You would need to put up $9,385. Probability of profit, 82.5%. But look at the return, a whopping 1.23%. Not very exciting. So rather than putting up $9,385, what you can do is you can look at Starbucks, you can buy the $90 call, or put, the $90 put, and you could write the $95 put. Now, if you buy the put, that is your protection to the downside. Now, I want to just walk through a couple simple numbers. if you bought 100 shares of Starbucks today, speculating to the upside that this is going to be part of the rebalancing, you would be putting up $10,165 for 100 shares of this stock. Okay, if that's the case, what you can do instead is buy that put at 90, because if the stock falls under 90, you can't lose any more money. You are now putting up, instead of $10,165, you could put up $435 to make $65. This is a 14.9% return, 152% annualized, and your break even for this trade is $94.35. The shares are at 101. The probability of profit of this trade is $800. If this stock were to fall to $90 in the next month, you would not be losing $1,100 on paper the way that the Starbucks operates. You would be risking $435, a significantly different drop. But you also will have the opportunity to buy the stock at that level if you are a longer-term investor. The way that these options work is if it falls below $95, you're likely going to buy the stock because, again, this has that long-term, the long-term potential of Starbucks. You have analysts behind it. It obviously is a great brand and a great company, and this within an allocation model would be part of your growth and income portfolio. But if the stock moves higher because of the rebalancing, or the stock just moves higher because of momentum in the market, the value of the put spread that you sold will go down. So that 65 value today could quickly move to $15 in 3 to 4 days, or maybe even 2 to 3 weeks. If the stock goes up, the value of the put spread goes down. You can buy it back and take that capital. If the stock trades sideways for the next month and a half, doesn't do anything, you're going to make money. And if the stock falls, but it never gets under $95 on or before April 18th, you're going to keep all of that premium. So that's a little bit more of a midterm level way to trade this. And instead of speculating wildly, you can simply go in and sell the put spread. Now, the other way to trade this, which is a little bit different, is instead of maybe buying a stock because, again, another $11,000 in cost, you can do something that's known as a call spread. And with Starbucks, remember, the current share price of Starbucks is $100.42. So if that's the case, what you don't want to do is you don't want to put up $10,000 to do this. Instead, what you can do is you can effectively trade around using a call spread that is in the money. So rather than speculating to the upside of the 105 call in, say, August, you could buy the $95 call, which is currently $8, $800, but then you turn around and you sell a call that is at the $100 level. And I'm going to show you very briefly that by doing this type of trade, you have a really interesting breakdown here. Because the way that this trade is structured, rather than putting up $10,165, you can do this spread. Buy the 85, sell the 100. So you're buying in the money and you're selling at the money. And here you're putting up $363 to make $137. Your return on this is $37.70. Your break even for this trade is $98.63. Your probability of profit is 62%. Now, I know you're looking at this and you're saying, well, wait a minute, this isn't 100%, 300%, 500% gains. Let me tell you something. If you want to try to get those types of returns as an options trader, you're going to be buying things that have a probability of profit in the 10 to 15% level. You are buying a lottery ticket. If you are focusing on managing your risk and you want to speculate to the upside and you think that Starbucks is going to be one of these companies, and keep in mind, let's look at Starbucks' numbers. This stock has consistently found support down around that 96.77 level, or 97.66 level. It's coming off of that short-term bottom. This type of spread has a break-even of 97.63. Probability of profit 62.8%. And then if you use Option Profit Calculator and you analyze the potential of these trades, let's just set this up in a way that you can see if this stock trades sideways and does not do anything, it stays at $101 for the next 6 weeks. You're going to start off, yeah, you might be down if the stock pulls back to 101, but if it just stays above 101, you're going to make money. If it stays above 100, you're going to make money. If it stays above 99, you're going to make money. But what's nice about this is you can see ahead of time through the lens of no implied volatility change whatsoever. If this stock pulls back, you know exactly what your potential loss is. So if you set up a trade like this, you can see ahead of time what your stop loss would be. And my recommendation is that the stop loss should be about half of what the total upside return would be in this type of trade. So if that is the case, that would be at about the 15% level. So if this stock fell to $99 next week, you would be out $56. You have about a 15% loss in the trade, but you're out and you're disciplined about it. But if this stock just holds and continues to just putter along, time decay will turn what looks like a loss on paper ultimately into a win. That's the other way. Now, on the 24th, we're going to be actively trading this event. It's very, very difficult to specifically note how the QQQ is going to behave. I don't know what it necessarily will do, but I do know that there is going to be a dramatic reaction by a large number of traders once these changes are announced and ultimately once they are implemented. One of the things that we have focused on at Flashpoint is to teach people how to trade the reversions in the daily type of environment. So as we look at the current status of the Qs, if we had a sell-off down to this lower band, that becomes an opportunity to step in and buy alongside the machines at certain types of the day. Now keep in mind, it's not just the QQQ that you can trade. There are plenty of ETFs that are going to be impacted by this. Remember, with the weight that is shifting on the Qs, any ETF that is weighted to the Nasdaq or is structured the way that the Nasdaq is going to change its weight. Much like there are many ETFs that have the compositions of the S&P 500 ETF, there are ETFs that effectively replicate Qs because they are technology ETFs that are heavily weighted in those names of Microsoft and Apple and NVIDIA. But the bread and butter trade, the best type of trade, is built around the leverage. And there are two ETFs that are great for day traders and great for swing traders in a short duration period. And those are the TQQQ. This is the triple leveraged ETF for the Nasdaq 100. And this is a very useful and fun and engaging ETF with plenty of liquidity at all given times. I'm just trying to pull back and show you where there have been some reversions on this. This is not what I'm trying to do. One moment. Let me refresh this. TQQ. 5-day. There we go. So here is a 10 o'clock. This happened the other day. This is Tuesday. This is the TQQQ. So the Q started the day with a little bit of a pop. At 9:35, we had a sell-off. Came all the way down here to this second standard deviation band, moved a little bit into the third deviation band, and then it just takes off. And you have something that goes from 93, 39, 33, finishes the day at 40.57. That's a $120 move with 100 shares of this. There are options on this as well, and they expire every Friday. So you can use the leverage ETF, the options around that ETF, and trade it in a day trade fashion. And all you're trying to do is make money moving from line to line, and then you simply use the deviation bands as stop points as you trade through the day. If we have a momentum breakout in the market, if the market likes this news, keep in mind, it doesn't all have to be bad news. this could actually trigger rotation into a lot of other stocks, companies like Starbucks and Gilead, and that can actually provide more confidence in the Nasdaq. There are going to be a lot of people who are going to be out there saying, well, this is going to trigger this massive sell-off in Apple. You don't know that. In fact, when a lot of people all come together and say this is going to happen, this is going to happen, this is going to happen, what we ultimately find is they're absolutely wrong. So the only thing that you can do in that situation is to react. It's to react into the news and react to the market. And the cleanest way to react to the Nasdaq will be on the 24th. It'll be live, and we will focus on the TQQQ and the SQQQ. And if you watch the QQQ, and you will see the QQQ move, it's moved below volume weighted average price. At that point, this is Wednesday, that is where you step in and you buy the SQQQ. And the SQQQ is the inverse ETF for the Qs. And as you can see, you can trade this 10 shares, 50 shares, 100 shares, however you want to do it. But if it breaks above volume weighted average price, you try to ride it to the upside. And if the Qs really start to revert and we start to see a negative pattern in the Nasdaq where money is flowing out of the market for any number of reasons, this becomes a tool that you not only day trade, but then you can hold it for 2 to 3 to 4 days and just give you a little bit of a sense of how this has moved in negative momentum patterns. The best example of the last year would be either the June sell-off that started on the 8th, when, remember, momentum went negative. When momentum went negative, we said we got to get out of the market and pull things. This went from 45.76 to 66.50 in about a week. Same thing happened during that sell-off in August of last year. 37.28 took you all the way up to 68. This was about a month and a half. And then all you do is, if you're entering these positions as you see a negative momentum event or something significant may happen as a result of the QQQ rebalance, you simply set a stop back at your entry point. So if you bought it at 37.50 and it pops and you're still holding, hopefully you're taking gains along the way, and it pulls back to 50 to 40, people might start to panic and say, well, the market's completely rallied. No. Just go back and set it where you entered it. Don't have any emotion about it, because sometimes what we've seen is you get a sell-off, it gets into short-term oversold conditions, people then come in, buy the dip, try to squeeze things out, and then the market absolutely moves much, much lower. The SQQQ has been pounded, obviously, because the Nasdaq has been absolutely on fire this year. But if you look at the TQQQ, the way as the SQQQ goes, the TQQQ goes the other direction. This year, year to date, the TQQQ has gone from $17.50 to $45.18. So with this rebalancing, it may set another type of pop. It could fuel a sell-off. But all that matters is the momentum indicator that we have. Once the momentum reading comes in, if it stays positive, you would be in the Qs or you could be in the TQQQ for day trading. And if momentum is positive and you have a little bit of a sell-off in the day, you're constantly looking for, down here at this second standard deviation band, if momentum is positive during the day and the buy the dip crowd steps in, that forces more shorts out of the market, and it can lead from a move from $44 to $46 in roughly 2 to 3 hours. It can be very, very fast and furious. So these are the things that we talk about on a daily basis at Flashpoint. This is what we're going to be focusing on over the next 10 days. It's going to be very, very critical for people to really just understand the mechanisms of the market. I do not think that you can, with a pure crystal ball, go out there and accurately know which name is going to be the beneficiary. But what I have done over the last 48 hours, I've gone through all of the analyst reports that I have. I've read furiously on what are the companies that are going to benefit the most. And what we have seen is consistently names like Starbucks, Gilead, Mondelez, who else was on that, Booking. And then I just properly showed you the way to trade these. And instead of trying to speculate wildly to the upside and saying, oh, well, this money is going to potentially come in and take Starbucks up to 110, as I've noted, the way to properly do it, to cleanly do it, is to take part in the basic rule of the market, which is the rule of the market is purpose of it is to sell. So as a result of that, by structuring that, either that call spread that I talked about, the $95 call and selling the 100, or doing the put spread where you're able to protect yourself effectively lower than this entry point, than where This stock has consistently found its bottom over the last 6 months. That's the cleanest way to trade. Now, one last thing I want to talk about before I take some questions and we dig into some of the other things that are going on in the market. I want to remind you that the number one trade of this year is Occidental. I'm going to talk about this trade in about an hour and a half at this event. This chart right here is the Buffett buy zone. This is where Buffett has stepped in and bought $125, $250 million in shares consistently over the last year and a half. And this is a bread and butter trade that we continue to exploit in Flashpoint over and over and over again. And when you do these types of trades, the one that we are doing with Occidental on a regular basis, if you do it 6 or 7 times in a year in positive momentum conditions, you can double your money just on that trade. But it's not one trade. It is a series of 5 or 6 of them. And you can turn $300, $400 in trade, consistently make 20%, put it back in, make another 20%, put it back in, make another 20%. And then by the end of the year, you've doubled your money by simply managing this one individual trade. And when you work with me and you listen to some of the things I'm talking about, you're going to notice patterns in the market. You're going to find stocks that have very distinct characteristics, that consistently find bottoms. I just pointed out Starbucks as an example. And instead of wildly speculating around it, I want you to think about it as an investor, as a person who is buying a company. What is it that I want out of this organization? Do I want to own Occidental in the event that Occidental fell to 55? The reality is you damn well do. Occidental is an absolute leader in the Permian Basin. It is a company that once it gets to investment grade and pays down its debt, even though oil prices may be a little bit subdued at some point this year, maybe we're stuck at 65 to 75, they're going to continue to reduce their production costs. They're going to continue to expand their margin. They're going to continue to buy back stock. They're going to continue to return capital to their investors. And Warren Buffett can buy up to another 25% of this company, and he has consistently done it at the $56 to $58 level. So I'm going to be willing to all day, every day, sell put spreads down at the 55 to 52.50 level or the 52.50 to 50 level, because if I get assigned this stock, I know Mr. Buffett is willing to pay more money than I would be paying for it. And that is providing a floor for this stock. These are the types of things that we consistently identify in this environment. These are the types of things that we are looking to trade and make money on a regular basis. So if you're not a member of Flashpoint Elite, I encourage you to take the plunge with us. Be a member of this. I do a significant amount of work every single morning. You get a breakdown of the markets. I provide macro information. We do a dive into the momentum indicator itself. We focus on the Nasdaq, we focus on the S&P 500, we focus on the New York Stock Exchange, and of course, the Russell, the IWM. The one thing that you will learn working with us is you're going to see how momentum works. We view it through the lens of capital in, capital out of the market, but I bring it down to really 4 indicators: the relative strength index, the money flow index, the MACD, and the ADX. And as you can see, when you get above 50 here, above 50 here, you have a positive black line above red line, and you see that breakout on the ADX, you get all 4 of them moving in the same direction. That is very bullish for the market. It's bullish for an individual stock. It's bullish for an ETF. It's bullish for virtually anything that you look at. This is the pure measurement of price movement, buying volume, sentiment in the market. It is found in these 4 things. And it's not me saying that. It was in the book Stocks by the Numbers by the great Grant Henning. That book has been one of the most important academic pieces that I've read, and it's obviously a part of Value Quantitative Momentum, the work of Wes Gray. These are the types of academic approaches to show you that you can get edge in this market. You simply just have to stop looking blindly at charts or looking blindly at certain indicators or crossover lines or whatever it is. Focus on actual price behavior in the market. And there's nothing purer than RSI, MFI, MACD, and ADX. And then you focus on the day trading. There's nothing purer than reversion, Bollinger Bands, and effectively the standard deviation lines of price movement during the day. These are the tips and tricks that will make you a better trader, a better investor, and really most importantly, help you manage your risk. I am not in the business of you losing money. I'm trying to make sure that you can take control of your capital, that you can have confidence, that you can have conviction, but that when you go into a trade, you are doing everything you need to do to try to protect yourself in order to preserve your capital so that you can live and fight another day. I've heard a lot of stories about people who are like, I started with $10,000 and now I'm down to $2,000. That's not how this should work. You should not be losing more than $1,000 when you're trying to trade or invest. You should be able to get out of positions relatively quickly and then simply reboot, rebalance, and re-enter a new trade relatively soon. Now, is every trade going to win? Absolutely not. But that's why we're focused on the probability of success. I don't like to wildly speculate at 10, 15% probability of profit. I want to be able to make money and know that my probability of success is going to be above the 50% line and that I have a natural number baked in as a trader that I'm going to exit. And when it comes to long-term portfolios, stocks that I really, really like, I will have conviction around a number of names. However, unfortunately, sometimes the market goes the other direction. I don't control that. If there is a crisis, we have a momentum indicator that says, hey, it's time to get out, and I might have to cut some losses. But I know that I am not the last person without a chair when the music stops. In addition to that, we break down individual sectors. So there are 11 sectors in the S&P 500, and every single one of them has momentum baked in with them. And the reason that what I'm talking about specifically is the very idea that when momentum starts to sell off in, say, materials, there are ways to turn around and make money on an individual sector selling off. And as capital rotates from one sector to the next, you will start to see, for example, if materials start to continue to sell off today, momentum in materials may go negative. You're going to see companies like Mosaic, CF Industries sell off because money is pouring into, again, those big mega cap names because of the optimism in the market. If momentum goes negative on the XLB, we can turn around and we can short the XLB. We can use puts to do that. But again, our focus is higher probability of profit, a relatively tight stop, and looking to manage that trade accordingly. In addition to that, we focus heavily on things like high short interest. So there are a lot of tools that are out there. And I know one of my members, he said, I've been asking you, you got to give me your list of the things that you use. I apologize. I'm at this conference. I haven't had a chance to really sit down and do it, but I promise I will get to it. I'm going to try to do it this weekend. These are the names that have very high short interest. These are stocks that are being shorted by fund managers, that are being shorted by hedge funds. They borrow the stock from people who have a long-term interest in those shares. They sell them into the market and they try to create price pressure to make this stock fall. And then if the stock falls, they buy it back, they pocket the difference from what they sold it for to what they bought it for, and then they give the shares back to the companies that have the long-term exposure. That might be an ETF, that might be a fund, but as you can see, these high short interest stocks, big names, Carvana, Beyond Meat, Fisker, Upstart, these stocks are heavily shorted. And what is happening right now to Carvana? Well, Carvana has gone from $12 to $38 in the last month and a half. I'm not real wild on trading some of these names because I don't like their underlying metrics. I don't like companies that really should be bankrupt. But momentum, our reading went positive on June 1st. And that is exactly when this stock absolutely took off like a missile. And that is a large contingency of short sellers right now who are buying back their shares at higher prices, taking losses. And if you pay very close attention to these metrics, pay close attention to these numbers, you will see the companies with the very high levels of short interest are absolutely screaming higher late in this momentum cycle. Another name, Wayfair, 39 to 70. Now, I actively don't trade this stuff within my portfolio, but I have taught people and I continue to teach people how to do this. And the way to focus on this is the combination of a positive momentum cycle and then the companies that have the high short interest. And there is a very specific time of the year when you can step in and do this. June 1st was the first time. January 3rd was the other time. That was where momentum went positive to start the year. 34 took you up to 72. Massive sell-off once momentum went negative. Same thing happened to start the June. This thing has rallied higher. So if you're trading any of these big junky names and you're looking to try to make money on it, now's not the time to be shorting it. You want to wait until momentum goes red. And we obviously can measure that on a day-to-day basis. In addition, this gives you a good opportunity to know if you're going to short, when's the optimal time to do it. You want to be able to combine RSI and MFI. And then, again, people continue to try to short this stuff. Hedge funds are getting slaughtered, and I keep just simply stating, if you followed momentum, if you followed this indicator, and you had this every day, you would know it's time to get out of the way. Capital can flow in, and these things can absolutely take off. Completely illogical. I totally understand it's completely illogical that a company like Wayfair is rallying the way it is. But as I've said, I've talked about this in my morning letter. They made a brilliant move to buy the assets of Bed Bath & Beyond, their IP for virtually $20 million, which is pennies. And now all of a sudden you have the stock that's taken off like a rocket, combining the high short interest with that momentum. This stock just continues to rock and roll. Now, when momentum goes negative, these are the types of things that we're going to obviously target to the downside. But at the end of the day, when it comes to shorting, educating you on this, I am not a wild trader of these speculative names, but I've learned over the last couple of years how to combine momentum and combine it with these individual names. And I would just want to continue to educate people on that type of trading strategy, because it can be a very viable thing for you, that as you make gains from, trades like Occidental, you make that 20%. That now gives you some play money to try to take aim at some of these stocks in the event that momentum goes positive and stays positive and we have a sustained rally. Finally, the last thing that we do focus on is insider buying. Now, insider buying is something that we tackled obviously today. If we look at insider buying, SEC Form 4 is what I use. Every single day, I put out this list. This is the large insider buys of CEOs, CFOs, and other executives over the last 10 days. And as you can see, Asana is on there. But I'm really focusing on CFO and CEO data. And as we can see, CFO and CEO data, these names are the ones that have lots and lots of buying from their executives. And if you look at a company like Children's Place, which I'm not a big fan of this company, but their CEO stepping in and bought $1 million of shares on July 6th at $23.11. You can see that the directors sold it back in June of last year for $48. The stock's been cut in half. And if you are looking at a stock at $23.70, what is the benefit of trying to buy this stock? Well, actually, insider buying is the number one anomaly in all of the markets. The biggest alpha gains in the market are actually by the executives who buy their own stock and the time frame between when they buy it and when it is announced. They are exploiting undervalue in their own stocks. And when you have positive momentum and you have insider buying, and then you combine a put spread strategy that we've talked about, where you go under where that CEO bought, or maybe you go even lower, much lower, maybe 15, 20% lower, what you may see is you sell a put spread on this stock. These executives look at their shares, they think they're undervalued. If you sold puts down around the $20 level on a name like this, and it fell to 21, the CEO may step back in and buy another $1 million of shares, because if they liked their stock at $23.70, they would probably love it at $21.50. So these are the types of other things that I think are critical for people to understand. Different ways that you can trade. We want to qualify everything. It's very important. You have to ask yourself, why is this opportunity being presented to me right now? And that's kind of why we make this little trade this morning on Asana. Asana right now with big additional insider buying from their CEO. I like it as a momentum stock heading into next week. So we're going to take a little bit of a plunge on that stock as well. We're obviously watching BFLY as well today. So that is really the point of today's conversation. There's a lot of opportunities for us as members of Flashpoint Elite to trade, to focus on higher probability, and to trade these big events. And we'll talk a little bit about just kind of track record, some of the stuff that we've been talking about. We bought into the Permian Basin a couple of weeks ago. You may have watched that Permian event back in February and March. I was just at an event. I'm sitting here talking with some people here about their opportunities in the Permian. I met with John Malden yesterday. We talked extensively about the Permian Basin. And some of the companies that we tapped into, companies like Earthstone, companies like Ovintiv, companies like Permian Resources, they're getting off the mat and they're starting to move. And that event had, it took a little bit of time, but it got there. And we have been on, these stocks are really starting to take off right now. It's beautiful to see. The other thing is that we just added a portfolio. We have a long-term portfolio within Flashpoint Elite. It's not just about trading options. We have a long-term portfolio, a 2-year portfolio that is built around a combination of value, executive management strength, momentum, and other indicators around earnings growth. So what we focus on here is using something known as the Piotrowski score. That is the F score, and our focus is finding companies that have strong financial capital discipline, that have an F score of 8 or 9, maybe 7, 8, 9, combining that with a low gram score, coming up with a list of stocks, and then qualifying all of these names. Right now, the companies that fit those metrics, there are a lot of coal companies, for example. I'm not buying into a lot of coal because there's a lot of regulatory policies that are lined up right now that are impacting shares. We do have a position in an MLP in coal that is paying 12%, but I'm not going to speculate for a price move over the next 2 years. But we did start to look at companies that are in the housing market, in the materials market, other things that are in the banking sector that have very stronger long-term reversions with massive upside. We had a company that was by the name of SkyWest, which is an airline company. I did not necessarily know that this was going to happen, but we bought into the stock at about $15 back in January, and we sold calls on it at 18. So we capped ourselves out at about an 18% return. That stock is going to be called next week at roughly $17.50. So we will make 18.1%. But unfortunately, the stock went from $15 to $40. So there was a 123% return on the underlying stock. Like, I was happy that we made that gain, but these names, these companies that have these very strong management scores and these very strong low gram numbers, they present opportunity not just to buy and hold those stocks, but also to sell put spreads on them to try to generate income, to find a lower price. And there's a lot of opportunity out there. So if you're trading options or you're just looking for a strong portfolio for the long term, Flashpoint Elite is definitely for you. I believe that we have a monthly offer in there that you can check out, and join us. Take advantage of the next 10 days. There's going to be a lot of activity. There's going to be a lot of movement. We gave away 2 trades this morning. The Asana trade, which we did the call on, and in addition to that, we were buying Butterfly. And then I walked you through the Starbucks trades of how to take advantage of this over the next 10 days, rather than trying to speculate wildly to the upside, how to use the spreads to the downside. So I hope that this has been informative for everybody. I don't have access to the YouTube chat, so I don't know. Okay. What do we got? Oh, look at that. Hey, Amin for the win. All right. Let me turn off the volume, though, so I don't go mad. All right, so audio is very low. Okay. So it's got the Asana stuff now. All right, just taking any questions that you have, please let me know. And I didn't know that I've been just sitting here looking like this ridiculously. Did you have my charts up, or has my face? Oh, okay. Did you expect the QQQ to drop with the rebalancing? Brody, I'm going to be really honest with you. I don't know, and I don't think anybody does. We've had that conversation. Yes, there could obviously be selling within the realm of the Apples and the Microsofts, but remember, capital is not leaving the Nasdaq. Capital is just simply being reallocated. So let's just put it hypothetically in the realm of you have a portfolio of $100,000, and you have an allocation model. And let's say, for example, you're following the Money Map report allocation model. And that report would be 50% of relatively safe things. Maybe you're buying the BIL ETF and you're structuring that with a Vanguard money market account. And maybe you have some gold in it, and that's your safety stuff. Then you have that 40% growth and income stocks. That might be a name like Starbucks that might exist in that world. And you put 40% of your money there. And then in the 10%, you have those more speculative names. Maybe you're speculating on a Tesla. Maybe you're speculating on AI stocks. Maybe you have stuff that's involved in blockchain. but that's kind of your like fun money, right? That last 10%. That's the proper way to structure a portfolio in a way that is responsible, that an individual can manage their money, not have to pay a broker, and certainly not have to have a significant amount of ETFs where they're paying expense ratios to those executives. So the way that I look at this is, let's say that your portfolio goes up 7% on the year, your 50-40-10 portfolio, and you've got an overwhelming amount of money that has been up as a result of the 40% gain. Your 50% gain portfolio is effectively flat. Let's say that's up 3%, your 40% portfolio is up 15%, and your last 10% is effectively flat, or maybe it's down 2%. What you have to do at that point is rebalance your entire portfolio. You need to get back to the allocation of 50-40-10. So you will carve some money out of that 140% bucket and then distribute it to the remaining buckets. That way everything is rebalanced. You don't lose money in the process of rebalancing your portfolio. You're just simply reallocating it to other assets. And that is what is happening here. You're having money that may come out of Apple and Microsoft and some of these other names, but it's flowing into the Starbucks or the bookings or some of these other names. And why is that relevant? Well, it'll be interesting to see how the Qs perform and how people react. But yes, Apple and Microsoft may decline a little bit, but would these companies effectively lift the other side of that weight and just keep the Qs at the level that they are at? That's actually the goal of the Nasdaq. The Nasdaq doesn't want to try to spur some type of sell-off that's going to fuel people to pour out of the market. And obviously the money managers, the Qs and the SQQQ and all these other managers, they're not trying to see money flow out because they're paid on their expense ratio. So the only thing that you can really do in that environment is react. You can speculate on names like Starbucks, as I've talked about, but I would focus on taking what the market is giving you. You have seen consistency of Starbucks kind of balancing out at that $96, $97 level. If it is a beneficiary of more capital flow into it and more people pile into it, then obviously you're going to make money because the value of the stock goes up and the puts that you were selling goes down. That way you can buy it back for even cheaper and then you pocket the difference, much like, say, a short seller would. The key thing to keep in mind is the purpose of the market is to sell. The purpose of the market is try to recognize that there are certain resistance levels that can be exploited, and there are naturally baked in types of things that you can look at specifically and know, hey, it does not matter if the market goes up or down. It does not matter if Starbucks goes to 98. I can still make money on it regardless of its movement. The last thing to keep in mind is I do not think it is, in this environment, there are three ways to make money. The first is to day trade. The first is to do what I've showed you with deviation bands, and that is reactive. That is what you will be doing over the next five to 6 days, Monday through Friday and next week, and then certainly the rebalancing issue of if it becomes a psychological issue where the markets freak out simply because of the rebalancing. I don't know if that's going to happen, but it is a distinct possibility. You have to think in terms of a distribution of possibilities. If that happens, then you know that you have the TQQ and the SQQ that you can trade in a day trading environment using deviation bands and looking for people to buy the dip or to trade based on the intraday behavior. The second is to go out within a 4 to 6 week period and sell puts and try to generate income off names that are at those type of resistance levels, right? That Occidental trade, that Starbucks trade. And what you're looking for in that environment is an 80% probability of profit, a 20% return, and an annualized return of 100%. And what I like about that is that means that you can do this trade multiple times. And if momentum conditions remain positive and support levels hold up, you could potentially double your money on that individual stock simply by trading those spreads over and over and over again. And the last way is to simply go out and say, to hell with all of this, I'm going to focus on the long term, and I'm going to look at a 24-month period. I'm not going to worry about the Nasdaq. I'm going to focus on companies with strong F scores, low gram numbers, and look for reversions in those names. And we had a list of them about a week and a half ago. Unfortunately, GasLog decided not to sell itself, so we had to step in with a different company that is in the natural gas export. That's gotten a bump. Thank you to Mr. Buffett for his investment in Dominion. Natural gas exporting looking very, very strong moving forward. All right. We stopped out of the Asana trade already? Jeez. Okay. I'm going to let it run. All right. I'm just looking at. So, Brett, the long-term portfolio stuff, that's actually going to be coming out in about 2 months. That is going to be part of our Republic research. And as far as the breakdown of that strategy, that is within the Money Map report. That is Shah's letter. So check out the Money Map report. That has that breakdown. Marla, how is that PR trade doing? We did Permian Resources. Permian's pulled back today, so people are taking profits on some of those names. But OVV, Ovintiv, that's down to 38. If you haven't been in some of these names yet, and you got a little bit of a pullback on some of these energy names, there's an opportunity to step back in today and start looking to go long on some of these companies. ESTE has been our preferred name. That's been our top performer. It's pulling back today. I get it. 4.8% today on the energy. Still remaining long on that. We got in on the 13. I believe Truist put a $32 price target on that stock about 3.5 weeks ago. It had another company step in and give a $29 call. So that's ESTE that we're focused on. All right. It is 10 o'clock. I have to prepare for a event today. That is going to be live. The members of Flashpoint will have access to that. I'm going to let everybody know, just so you know, I will be talking about the Graham number and the F-score today, but John Malden's going to be talking as well. He'll be talking about a company in the agricultural space that I talked about in the Flashpoint letter this morning. He is extraordinarily bullish on it. I'm going to be digging into it. Obviously, you know, I have an agricultural background, so I'll be giving that ticker out today with our Flashpoint members. In addition, we have Adrian Day. He'll be talking about international markets, and then the head of Stock Market Almanac with his top picks. I will likely keep my focus in the Permian today, most likely talk a little bit about the pipelines as well, particularly the individual independence fund that is a part of Flashpoint. The ETF, or the closed-end fund, is trading at a 16% discount to its net asset value. Do not give this away, please, my friends in Flashpoint. Don't type this ticker in. 16% discount and a 9% dividend, and it contains virtually all of the primary players in the Permian Basin. I am going to be signing off right now. I hope you all have a wonderful day. I hope this was informative. I hope that you have all the ammunition that you need moving forward in order to take advantage of this rebalancing and the macro trends. My name is Garrett Baldwin. I am the head of Flashpoint Trader, Flashpoint Elite. It is a service for investors and traders who are interested in learning a lot of different types of trading strategies and investing strategies that match not just their return expectations, but also teaching you to understand and really identify what your level of risk tolerance is before you make a trade. So do yourself a favor, sign up with us today, be a part of this over the next 10 days, take advantage of it, check out all of the resources that I have built for people, take all the information in. I am a professional trader, an investor, academic. We do this type of session every day for at least 30 minutes, from 1 o'clock to 1:30, or sometimes 1 o'clock to 2:15, depending on how much there is. We always answer questions. We always take advantage of one another's ideas. It's a great community to be a part of. So everyone in Flashpoint, I absolutely love you. I'm looking forward to getting back home, sitting down with you. I'm not going to be traveling for the next month, which will be nice, so we can really dig in and dive into other trends. Join today, click the link. Looking forward to seeing everybody, seeing new members on Monday. And I hope you all have a great trading day. Remember, focus on the deviation bands for the rest of the day. Do not invest what you are not willing to lose, or trade what you are not willing to lose. And take advantage of Flashpoint so that you can be have a firmer understanding of your risk tolerance and how to manage that risk, and pick trades with a much higher probability of success than what most people are talking about in today's environment. Have a great day. Thanks so much for your time. Enjoy your weekend.